Hi and good evening, ladies and gentlemen. Thank you all for joining us tonight for this webinar. We've set ourselves a bit of a challenge by saying that we have some ideas that can outshine fixed deposits in 2023. But we believe we have these strong opportunities, which we really want to share with you. We believe savvy investors like yourselves will definitely be able to benefit from this. So without further ado, I'm going to introduce Hui Shi, who will kick us off with the first part of the presentation, followed by Teng Chong, who will come after as he shares some bond ideas. So without further ado, let me just hand the time over to Hui Shi. If you have any questions, do drop them in the Q&A section, and our speakers will get to them at the end of the presentations.
Hello, everyone. I'm Hui Shi from the research team. So thank you so much for joining us today. And for a quick recap, we think that last year was definitely a very tough year to make money in the global financial markets. Stocks and bonds, they were all beaten down as a result of aggressive rate hikes from global central banks, including the Fed. And in particular, bonds, they were sold off more than stocks. And many investors, they began to look towards risk-free investments, including fixed deposits to protect their money. But what has changed now is that with higher interest rates as a result of the many rate hikes, fixed income investors can finally tap into attractive yields that have been hard to come by for many, many years. And at the same time, while stashing your money into fixed deposits appears to be a very reasonable option, we believe that today it is no longer the best option anymore. In fact, we do have a couple of fixed income ideas that we think will outshine fixed deposits this year and even beyond. So for my part, I'll be focusing on bond funds. And in particular, we think that short duration bond funds can potentially outshine fixed deposits. We believe that 2023 could be a better year for fixed income as the bulk of rate hikes is likely already behind us. And given that short duration bond funds, they do take on credit risk, they can actually offer a yield pickup over fixed deposits. So this provides investors with the potential to receive more attractive returns over time, even if the near-term market volatility persists. And by investing in your high quality investment-grade short-term bonds, as well as money market instruments, short duration bond funds are able to give yields that are around about 2% higher as compared to fixed deposits, which are being offered by the local banks. And this potentially higher returns from these short duration bond funds can help you to keep pace with inflation. Singapore's core inflation rate stands at slightly over 5%. And if you only invest in risk-free options like fixed deposits, the chances are that you won't be able to keep up with this high inflation. So in other words, putting tons of cash simply in fixed deposits means that the real value of your money is being eroded very quickly. And furthermore, short duration bond funds, as the name suggests, they invest in bonds that are shorter dated. And with the underlying bonds that mature relatively quickly, these funds are able to reinvest into higher yielding bonds during a rising interest rate environment. And we think that interest rates are likely to remain higher for longer, as Fed officials have stressed the need to keep raising interest rates. And the hotter than expected January CPI data has raised the possibility of a higher peak level than previously expected. And last but not least, bond funds, they can provide investors with liquidity. I feel like liquidity, this is often overlooked when investors focus too much on the yield. Liquidity, which refers to how easy or quickly you can access your capital if needed, it plays a very important role in a portfolio. So having liquidity allows you to seize opportunities, because if an even better deal comes along in either the stock or the bond markets, it will be easier for you to capture it if you have liquidity. And fixed deposits, they usually lock up your money for around 6 months or even up to 1 year with penalty charges if you have to withdraw early. And on the other hand, bond funds, they are much more liquid, as you can buy or sell them in a few days with no penalty involved. And with that, I also want to take this chance to share our house views on the interest rate environment and by extension, also for the fixed income asset class. So although yields, they have indeed increased substantially across the maturity spectrum, short-term bond yields have risen a lot more as compared to the long-term bond yields. And recently, we saw that the inversion of the US Treasury yield curve has reached its deepest levels since the 1980s. And this is because short-term bond yields again have moved higher as compared to long-term yields. short-term yields, they are mainly driven by the expectations of how high the Fed terminal rate can go or will go. And this expectation has increased after the release of stronger than expected January employment as well as inflation data. And meanwhile, for the long-term bond yields, they are driven by not only economic growth, but also inflation expectations. And a key reason why long-term yields have not risen as much is because there's a lot of optimism that these inflationary pressures will be very strong and that inflation can quickly go back to 2%. However, in our view, we think that inflation may still prove more persistent than expected, even if a recession comes. Because the US labor market remains very tight, there's still a continued scarcity of workers in the labor market, which could continue to exert upward pressure on inflation. And furthermore, energy inflation, it could make a comeback in 2023, especially as China reopens its economy. Besides that, we think that deglobalization, which is driven by rising geopolitical tensions, is another factor that will drive inflation for the longer term. And moreover, based on historical data, inflation across advanced economies, as shown by this chart on the right here, it has taken an average of about 10 years to return to 2% once it breaks the level of 5% inflation. And as such, even if a recession comes, we think that a Fed rate cut this year seems very unlikely in our opinion. And in our view, we think that short-term yields, they are likely to remain quite supported. And for the long-term yields, we believe that they have the potential to move up even further. And that also means that long-term fixed income investments, they actually do not sufficiently compensate investors for the term premium, which includes the risk that inflation may be more persistent than markets are anticipating. And therefore, our preference within fixed income is for short duration bonds over the long duration bonds. And within fixed income, we also believe that investors should move higher up in quality. High yield bonds, they do offer very attractive income, but it comes with greater risk of spread widening amidst the challenging macro backdrop, as investors, they could demand greater compensation for higher credit as well as default risk in a challenging environment. So going for safer segments like investment grade bonds will ensure that you can capture the higher yields from fixed income without having to take on too much credit risk. So these are some of the reasons why we like investment grade bonds that are on the shorter end of the yield curve. And I also want to point out that short duration bond funds, they utilize this strategy, which is called a laddered investment strategy, which enables them to cope with different market environments. So what this means is that the fund staggers its bond investments across a certain time frame, like 3 years, for instance, based on this example shown on the screen. So this will ensure a steady stream of cash flows while enabling the fund to ride on the momentum of rising interest rates for the purposes of enhancing total returns for investors. Also, let's say, what if the Fed cuts interest rates next year? How would the fund's portfolio yield look like? As you can see from the chart on the bottom on the screen here, in the environment of lower interest rates, the fund's capital stays invested in the longer maturity bonds, and as such, the fund's portfolio will be able to maintain a rather steady portfolio yield. And for today, we'll be sharing 3 recommended funds that you can consider. And the first fund that we really like is the Nikko AM Shenton Short-Term Bond Fund, which seeks preservation of capital and liquidity. And to reach this objective, the fund invests in a diversified portfolio of good quality short-term bonds as well as money market instruments. And geographically, the fund holds Asian investment grade credits, with Singapore currently occupying the highest allocation at 22%. And China and South Korea also take up relatively large weights in the portfolio, though such non-Sing dollar exposures are actually hedged back to the Sing dollar to mitigate any currency risk for investors. And currently, the fund's top holdings are the banks due to their high credit quality and the fund's belief of the banks having very attractive valuations. The duration exposure of the fund is also relatively short at only about 1 year, and the fund also employs prudent management by keeping its portfolio duration at 3 years or less at any point in time. And the fund has also reinvested into higher yielding bonds, allowing its portfolio yield to reach 5.1%. And moving forward, this fund is seeking to enhance its yield via duration extension while keeping the overall portfolio duration within 3 years. The fund manager has also shared with us that it sees a room for Asian credit spreads to tighten, and this is being supported by China's policy shifts. And when credit spreads tighten, that also means that the fund's NAV is likely to increase, leading to gains for investors. But that being said, the fund manager is also quite cautious about the risks surrounding China, in particular, the risks regarding policy implementation, as well as policy predictability. And the truth is, China is no stranger to sudden major policy reversals, which can lead to a lot of uncertainty. So for example, China's sudden exit from its zero COVID policy is likely to be stop-start in nature, given the population's low natural immunity, as well as the country's less than equipped healthcare system. But all in all, what we like about this fund is its exposure to the relatively safer names, considering its average portfolio credit rating of A-. And the fund's maximum drawdown since inception was only at about -3.1%, which is one of the lowest among its peers. So this very good risk management characteristics makes it very ideal as a cash parking facility. And besides that, the second fund, which we find interesting, is the United SGD Fund. So it aims to achieve a yield enhancement over SGD deposits with a long-term view to preserve capital by mainly buying into Asian short-term and investment-grade bonds. So this fund explores investments in both the Sing dollar and the hard currency markets, allowing investors to access a larger investment universe. However, any foreign currency exposure will be hedged back to the Sing dollar to mitigate the risk of currency fluctuations. The fund is actually quite diversified across the different Asian markets. The highest allocation is to China at 22%, as the fund recognizes China's important and rather huge role within the Asian fixed income universe. But within China, the fund actually has a tilt towards bonds which are issued by state-owned entities whose economic values are driven by state policies, and they are of great importance to the Chinese government. And this view is partially being reflected in the sector allocation, whereby key sectors like financials and industrials take up majority of the fund. And what the fund manager has shared with us is that while peak inflation is likely behind us on the high base effect, they are mindful of cost pressures being faced by corporate credits. And as such, the fund is looking to maintain their preference for defensive positioning, with a preference for quality credits with leading market shares and of systemic importance in defensive sectors. Furthermore, we believe that the fund's focus on the safer and investment-grade credits would offer more protection on the downside. The fund also has an average credit rating of a BBB+, which is investment grade. We also note that the fund's risk management is quite solid. Since inception, it only showed a maximum drawdown of -4.4%. Its duration is at about 1.2 years and is expected to be kept below 3 years. And the portfolio yield remains rather high at 5.6%, despite a slight drop due to the tightening of credit spreads and a fall in short-term yields as compared to previous months. And the last fund I'm highlighting here is the Lion Global Short Duration Bond Fund, which targets investors who wish to earn a higher yield compared to fixed deposits and money market instruments by taking on slightly higher credit risk. This fund invests mainly in the Sing dollar denominated bonds, and naturally its largest market allocation is to Singapore at close to 50% of the portfolio. And while the fund may also invest in the Asian sovereign or the quasi-sovereign bank and even corporate bonds outside of Singapore, all of this foreign currency exposure will be hedged back to the Sing dollar to mitigate any currency risk. And in terms of sector allocation, the heaviest sector is in real estate. But that being said, it should be mentioned that this fund has been quite prudent in its Chinese real estate credit selection in order to mitigate any risk of downgrades or defaults. And moving forward, the fund manager has shared with us that it believes that Asian credit markets will continue to benefit from China's pivot from zero COVID, and they will be positioning their portfolio to benefit from such a situation. And in terms of its portfolio matrix, the weighted average credit quality is at BBB+, which is investment grade. its weighted average yield to maturity is at 5.4% with a duration exposure of 1.8 years. And both of these metrics are expected to increase moving forward as the fund manager does believe that yields have risen sufficiently enough for them to begin adding duration moving forward. However, one thing that we do want to point out is that this fund historically has showed a larger downside risk as compared to its peers. Its maximum drawdown since inception was at about negative 7.5%, which is larger than two of the funds that I've highlighted previously. And we think that this is mainly due to the fund's less defensive positioning in the past, whereby it actually had a lower average credit quality. In the past, the fund's average credit rating was at about BBB, but now it has moved towards higher quality credits with an average credit quality of BBB plus right now, which is about one notch higher. So overall, we believe that recommended funds will appeal to conservative investors seeking instruments that can help them to obtain a yield pickup over the Sing dollar deposits. The key risk here is that unlike deposits, your capital in your bond funds, they are not guaranteed. However, I do also want to highlight that the fund's exposure to short duration, high quality credits limits downside risk during market volatility. And also believe that this year, 2023, will be a much better year for fixed income. With the bulk of rate hikes likely behind us, today's bond yields are at their highest levels since the global financial crisis back in 2008. So this provides investors with the potential to receive more attractive returns over time, even if the near-term market volatility persists. And while the rising interest rate environment may also lead to mark-to-market risk for the funds, we think that this effect will be evened out eventually as the underlying bonds mature, which is relatively soon because the bonds are of short duration. And rising interest rates also enable the funds to continue to reinvest into higher yielding bonds, which will in turn push up their portfolio yields. And the three funds, NICO-AM, the NICO-AM Shenton Short-Term Bond Fund, the United SGD Fund, and the Lion Global Short Duration Bond Fund, they are all available under the CPF investment scheme. And if you have not been investing your CPF monies, I think it's a good time to start thinking about it right now, because Singapore's core inflation is at about 5%, and the 2.5% risk-free rate that's being earned on your CPF OA balances, which was once seen as a very good deal, now actually barely keeps up with inflation. And for inflation-beating returns on your CPF monies, other than T-bills, please do also consider these three short duration bond funds that we really like and recommend. And here at FSM1, we also have shared some ideas for a do-it-yourself DIY cash management portfolio for investors who are looking for better returns on their idle cash. So a DIY cash management portfolio, it actually serves as an alternative to traditional bank deposits while offering higher yields while still providing investors with a good amount of liquidity. And such portfolios, they mainly invest in fixed income funds, which are on the lower end of the risk spectrum, such as the funds I've shared previously, or even money market funds. And while cash management solutions are not difficult to find nowadays, thanks to many of the robo-advisors out there, we think that a DIY cash management portfolio offers investors with greater flexibility. Based on the abundance of funds available on our platform, a DIY cash management portfolio can be tailored to suit your risk profile as well as your desired yield. And investors on the hunt for higher yields by way of a DIY cash management portfolio can consider a very simple three-step approach. So for us, we think that the first step would be to choose an anchor, which are funds of lower risk. This kind of funds, they tend to generate reasonable returns at a relatively lower volatility, and hence they are able to serve as a stabilizer for your portfolio. And the second step after this is to add some yield enhancers, which are funds with exposure to higher credit risk or volatility. And as the name suggests, they can potentially provide higher yields for your portfolio. And after identifying the funds, you can mix and match them to form a portfolio. A conservative investor would allocate the majority of their portfolio into lower risk funds, which we define as an anchor. And for investors who want to undertake more risk, you can allocate more of your capital into funds with higher credit risk or volatility, which we define as a yield enhancer. And as the risk of the portfolio increases, we also suggest having a greater variety of underlying products. for diversification purposes. And there are also idiosyncratic risks relating to each fund manager. So you also want to diversify across different fund managers as well. And to illustrate what I've just said just now, here's a conservative model portfolio. So for this portfolio, 80% of the allocation is in an anchor, which is the Nikko AM Shenton Short-Term Bond Fund. And meanwhile, we have put the remaining 20% of the portfolio into the United SGD Fund, which is also the yield enhancer. So the fund, given that it takes on higher credit risk, it provides room for outperformance on a total return basis. And overall, we think that this portfolio is expected to generate a net yield of about 4.7%, which can potentially beat the Sing dollar fixed deposit rates. And for more, do also check out our article on FSM1, where we also shared more about our moderate as well as aggressive model portfolios for even higher yields. Other than that, if you're holding on to excess cash in US dollars, you can also find ways to earn higher yields. You may combine the Nikko AM Shenton Short-Term Bond Fund with a fund called the Fidelity Enhanced Reserve. Although this Fidelity Enhanced Reserve is not on a recommended funds list, we do like this fund for its investment in short-dated, high-quality bonds, which provides the overall portfolio with stability. And overall, this portfolio is expected to generate a much higher yield of about 5.4%. And this is being largely pushed up by the Fidelity Enhanced Reserve, as its portfolio yield for this fund is at about 8%. And again, do also check out our article on FSM1, where we also shared more about our USD moderate as well as aggressive model portfolios. And with that, I've come to the end of my sharing on some of my fixed income ideas that I think is able to beat fixed deposits. And with that, I'll hand the time over to my colleague, Teng Chong, who will be sharing with you some more ideas.
For the presentation. So good evening, everyone. I am Teng Chong. So for today, I'll be sharing some fixed income ideas. But before I start, I would like to discuss about what has happened in 2022. So in 2022, we saw interest rates in Singapore surging to record high levels, never seen in decades. So yields for the Singapore savings bonds were constantly breaking their record levels since its inception in 2015, while SGS T-bills reached 4.4% in December of last year, and that was the highest since 1988. So as major economies grapple with higher inflation, central banks around the world have opted to undergo monetary policy in order to bring down inflation, particularly in the US, where we saw aggressive rate hikes from the US Federal Reserve, hiking its Fed funds rate from 0.25% to 4.75%, which is one of the fastest rate hikes ever done by the Fed. So the surge in interest rates have also caused higher competition for funding in Singapore. This is because banks borrow cheaply in the short term through deposits and then lends out this money at a higher cost through long-term loans. And the competition to secure funding have also risen. So in DBS's recent earnings report, DBS reported overall outflows from its current account and savings account in the second half of FY22. So Sing dollar savings account deposits were down 11.4% year-on-year as consumers opted to place their monies at other alternatives such as Singapore government securities in order to generate a higher yield. So from the chart on the right, we can see how interest rates have risen quite substantially in 2022. I have to first point out that the tenor of these products listed on the graph are not the same. So for SSB, it is the return over a 10-year period, while for T-bills, it is for 6 months. And for fixed deposit rates, the tenor of various FD rates differ among banks with varying minimum amounts. But I think what I generally want to show is how rates have risen quite quickly in 2022 and which products currently provide the highest yields. So initially, it was the SSBs that were giving the highest yields, but the SGS T-bills overtook it at the midway point of last year as short-term rates have become much higher due to the inverted yield curve. Fixed deposit rates have also risen in tandem, but were largely losing out to the government securities until at the end of the year, where the fixed deposit rates largely matched the yields for the SGS T-bills. So as interest rates continues to remain high in Singapore, which interest yielding product is the best for you? And over the past year in 2022, SGS T-bills have been one of the better alternatives, giving yields that big fixed deposits and SSBs for only a short tenure of only 6 months. And its low minimum amount of 1,000 Sing dollars also makes it a more attractive option over fixed deposits. However, in recent times, we have saw the cutoff yield for the T-bill auctions to be falling after its high in December. So in the T-bill auction on the 7th of February, the cutoff yield was 3.88%. And in the T-bill auctions today, the yields have actually gone up to 3.93%. So yeah, as the yields fall below the 4% mark, and this may confuse some investors out there, as the Fed is still undergoing interest rate hikes, but yet yields are on a downward trend. And this is because short-term interest rates move on future expectations of interest rates. So on the chart on the right, I've plotted the 2-year Treasury, US Treasury bonds against the Fed Fund futures, with the contract ending on January 2024. And we can see that it's very highly correlated with each other. Although this is for the US, Singapore's interest rates are largely determined by the US Fed, as we adjust our exchange rates based on the exchange rates of our trading peers, with US being one of them. So as expectations that the US Fed will require lesser or lower rate hikes in the future, short-term rates will not continue to rise. And this is because markets are forward-looking and yields are not priced in just for the next rate hike, but are already looking ahead in 1 year's time. So as we reach closer to the market's expectation of 5%, lesser rate hikes will be priced into the SGS T-bills, leading to lower yields. However, of course, that is not to say that yields will continue to be on a downward trend. Yields may rise if inflation does not fall below the Fed's expectations and if they continue their rate hikes. And we also saw confounding data from the recent US job reports, showing a continuing tighter labor market, albeit the tech layoffs in the US. So if the US Federal Reserve continues to hike past 5%, we may see a rebound in T-bill yields. Other than the products mentioned previously, I would like to also bring your attention to retail bonds, which yields have also risen in tandem with rising interest rates. This is because bond yields are positively related to interest rates. So when interest rates rise, bond yields will rise as well. So retail bonds are bonds that are offered to retail investors in Singapore. So for normal corporate bonds, it may be hard to invest in it, as the minimum amount required is 250,000 Sing dollars. And because this is a corporate retail bond, it is not as risk-free as compared to the Singapore government bonds, as there is credit risk and default risk in the bonds. However, this also means that investors will be compensated with slightly higher yields over the Singapore government securities. Investors can also choose to sell their bonds on the secondary market in order to get back their principal. So tenor is not fixed like T-bills or fixed deposits. So with views on the recent SGS T-bills falling, I think retail bonds are a good alternative against the T-bills and fixed deposits. And the yields for some retail bonds are still yielding past 4%, and with good credit profiles that have lower default risk. And one of the retail bonds today I would like to share today is the Astria private equity bonds. So Astria PE bonds are issued by Azalea Asset Management, and Azalea is a wholly owned subsidiary of Sivora Holdings and indirectly owned by Temasek Holdings. So they are set up in 2015, and Azalea has its own board and management team independent of Temasek. The company is focused on the development and creation of investment products to provide investors a wider access to private equity. So what are PE bonds? So PE bonds are asset-backed securities or bonds backed by cash flows from private equity funds. And cash flows generated by these PE bonds will be used to pay the interest payment and the principal of the bond. So Azalea has been a frequent issuer in the retail bond market, and the most recent issue, the Astria 7 bond, the recent issue, the Astria 7 bond, marks its 5th installment of its PE bonds on the Singapore retail bond market. How does the interest and principal is being repaid through this through the PE bonds? So in this illustration, it shows the bonds priority payments. So let's start with the 38 PE funds on the bottom left. So cash flows from the PE funds that are being invested will be distributed to the asset owning companies and then to the issuer of the Astria bond. So in this case, it's Astria 5 Private Limited. So at every distribution period, the available cash flows will be first paid for expenses such as taxes, hedge counterparties, manager fees, and as well as its credit facilities. So at this stage, there is also a cap on the aggregate amount of taxes and expenses being paid of $900,000. So next, the remaining cash flows will be paid for the interest of the bonds, and then followed by it will be paid to its reserve accounts or the repayment of the bond principal on the call date or maturity date. And then lastly, the remaining cash flows will be used to pay the remaining taxes and expenses and the other hedge unwinding costs, and lastly, payments to the sponsor. So within the Astrea PE bonds, there are also certain structural safeguards in order to ensure the full repayment of its bonds. So firstly, there is a reserve account in place to set aside cash flows received from the PE funds in order to build up its cash reserve in order to redeem the principal amount of its Class A1 bonds on the scheduled call date. So you can think of this as a piggy bank for the for the PE bond, where at every distribution date they will actually set aside cash, and then at the maturity date or the call date, they'll use this cash to actually repay the bond. Next up, there's also sponsor sharing. So sponsor sharing ensures that the cash flows still remain allocated to the reserve account, even after meeting their performance threshold. So in most Astrea bonds, there is a performance threshold when the sponsor receives 50% of the issuer's total equity. So instead of receiving and taking all the remaining cash flows, the sponsor will actually just take 50% of it, and the other 50% will be used to allocate the reserve allocate it to the reserve account to ensure faster building up of reserves. Next, there's also a maximum loan to value ratio, and it ensures that the portfolio does not get too over leveraged. So when the loan to value ratio of the portfolio is more than 50%, cash flows will be allocated to the reserve accounts until the reserve account cap has been reached. And then afterwards, they'll try to deleverage by redeeming the Class B bonds until the LTV reaches lower than 50%. And lastly, there are also credit facilities in place from DBS and Standard Chartered Bank, which can be used to fund certain expenses and other amounts during an event of a shortfall in cash flows. So with all that said, investors of the Astrea bonds are protected by these structural safeguards to ensure the full redemption of their bonds by their scheduled call dates. So one of the Astrea bonds I'd like to highlight today is the Astrea 5 bonds. So Astrea 5 invests in 38 PE funds from the largest PE firms, namely Blackstone, KKR, Carlyle, and Silver Lake Partners. So the current NAV for the Astrea 5 portfolio is $1.1 billion, which was down 5.8% from the initial NAV. But however, cumulative net distributions have totaled to around $1 billion. Currently, the LTV ratio is at 13.3%, still below the LTV ratio of 50%. And at its latest distribution date on the 20th of December 2022, $76 million was allocated to the reserve account. So $47 was reserved as part of as scheduled, and then an additional $29 million was reserved as part of the sponsor sharing safeguard previously mentioned. And the Astrea 5 portfolio reached its performance share threshold on the 20th of December 2021, as the sponsor have received $407 million of cash flows. As part of this bond feature, a bonus redemption premium of 0.5% will be paid out to Class A1 bondholders upon redemption. At its last distribution date on the 20th of December, a total of $459 million have been reserved for the redemption of its Class A bonds. And this is equivalent to 99% of the bonds outstanding. So while there is a maturity date for the Class A1 bonds on the 20th of June 2029, there is a call date on the 20th of June 2024, which is mandatory for Astrea to redeem its Class A bonds when the reserve accounts is sufficient to redeem all outstanding bonds in full. So in any event, if Astrea is unable to redeem the bonds on the call date on 2024, the coupons of the bonds will increase by 1%. So currently, the Astrea 5 bonds are trading at an indicative yield to call of 4.4% for about 1.34 years to its next call date on the 20th of June 2024. So other than Astrea bonds, there are also other retail bond alternatives like the Temasek 2.7% 2023 2023 retail bond with an indicative yield to maturity of 4.47%, with around 8 months to its maturity, as well as the SIA 3.03% 2024 bonds, currently at a yield to maturity of 4.17% and about 1.1 years to its maturity. So both the Astrea and Temasek are rated investment grade quality by credit rating agencies like Fitch and S&P. And Astrea is just a few notches below the rating of AAA of the Singapore government, while Temasek have similar ratings with the Singapore government due to their ties with the government. So all in all, we think that these bonds are providing decent yields above fixed deposits and T-bill yields and have strong credit rating and credit profiles. So other than SGS bonds and fixed deposits, investors can consider retail bonds to capture higher yields while also having predictable cash flows from your investment. So for more bond information or articles on our bond recommendation, please you can check out our Telegram channel at Bond Supermart for bite-sized information on bonds. And with that, pass my time back to Jonathan.
All right, thank you, Chong and Hui Shi. That was certainly an eye-opening presentation. Also, thank you to all our viewers who actually have been sending in your questions. I'm just going to share a few announcements while our speakers actually prepare their answers to respond to you. So don't go away yet. They'll be back to answer those questions which you have submitted. So the first thing actually I want to share with you during this time is actually you may have noticed that we have launched the FSM1 debit card. So this allows you to spend directly from your cash accounts. So whenever there is any investment proceeds or dividends or profits from what you have on your FSM account, you don't have to withdraw that money to your bank anymore to spend it. You can just spend it directly with the FSM debit card. And not only that, not only do you enjoy that convenience, you can also enjoy 8% cashback on your expenses, on your dining expenses in February 2023. So this is a really good deal, no strings attached. Anyone with the card can actually enjoy this. So about 2 or 3 weeks more to enjoy this promotion, 8% cashback on your dining spend. Okay, on the next slide here, I would like to also share with you about our FSM1 SG Research Highlights Telegram channel. So as you know, we post many different ideas, investing ideas, and we observe the markets and look for investing ideas which can help you to navigate your investments better. Scan this QR code, which is up on screen. I'll leave it there for just a couple more minutes. This will just bring you directly to our channel. Never miss an idea that will just get pushed straight to your phone whenever we have a new article that's up. If you don't have a lot of time, you can read the summary and the link to the full article as well as to the products which we recommend will be posted there. Okay, I'll just leave that up for a couple more minutes, and later I'll also put the link to the debit card offer in the chat section so you can refer to that easily. Okay, I'll show this slide later, or I'll put up the link in the chat section again so you can refer to it. Let's go back to our speakers now as they address your questions.
Okay, I will take the first question. It's a two-part question from one of attendees. So the first part will be asking about how these 3 short duration bond funds annual returns compare to their benchmarks. So for these 3 different funds, the first one will be GoAM Shenton Short-Term Bond Fund. For this fund, last year, even amidst this stock as well as bond market sell-off, this fund has actually delivered quite resilient returns, even though it posted negative returns, but it was only at about negative 1.2% for last year. That is for the GoAM Shenton Short-Term Bond Fund. And I do think that returns will definitely be much better from here on, because last year was a really difficult year for fixed income markets. We have a lot of aggressive rate hikes, and there's a lot of uncertainties regarding inflation numbers, as well as how much or how fast the Fed is going to hike rates. So a lot of these fears, they have led to a sharp sell-off in the bond markets. In fact, the global bond indices, they have returned about negative. They have delivered losses about in the negative double digits. So in comparison, this fund actually has performed very well with a return of negative 1%. And I think moving forward, returns will be better from here, because most of the rate hikes are already behind us. And right now, this fund also has a portfolio yield of about 5%, I think that will provide some indication of how much returns investors can expect from here on. And also, I want to point out that since inception of this Nickel AM fund, this fund has indeed outperformed its benchmark, which is the SIBOR. And I think that this outperformance since inception is an indication of the fund's good track record as well as the portfolio manager's expertise. So I don't think that you should just solely look at a 1 year of underperformance to determine the effectiveness of this fund to be able to pay out decent returns for you. So I do think that this Nickel AM Shenzhen short-term bond fund is actually one of our best short duration bond funds on our platform. And besides that, for the United SGD fund, it also delivered losses last year, but only at about negative 2.3%. So it did also underperform its benchmark, but compared to the rest of the global bond market or even the rest of the global bond funds, this fund has indeed done very well. And since inception, this fund has also outperformed its benchmark. In fact, all of these funds, their benchmark is actually a cash-based index, either the SIBOR or the swap offer rate. So since inception, this fund has also outperformed its benchmark. I think that this can provide an indication of the fund's manager's good track record as well. And lastly, for the Lion Global Short Duration Bond Fund, it delivered slightly larger losses of about negative 4% in 2022. But again, since inception, this fund has also outperformed its benchmark over the longer term. And also, once again, to remind investors is to not just look at 1 year of underperformance, because 2022 was really a bad year for global fixed income markets. And you should actually look across the even medium to longer term in order to determine this fund's performance and the fund manager's expertise. And the second part of this question will be about the mark-to-market impact. With the mark-to-market valuation on the bond fund, how does that how does the drop in bond value affect the higher yield returns? So when interest rate rises, the bonds in the bond funds will experience a mark-to-market impact, which means that the fund's value would drop in order to adjust to the higher interest rates. And this is also why you see that many of the funds in 2022 experience losses. And most of this is because of the mark-to-market impact and not because of any defaults or any credit downgrades. And with mark-to-market impacts, definitely the bonds value will fall, but that in turn actually pushes up the bonds yields, because when the prices fall, yields actually increase. So that would actually in turn contribute to the overall the fund's overall portfolio yield, and that will continue to go up as well.
All right, thanks, Hui Shi. So there's a question on what do the private equity funds invest in? So so how the private equity funds invest is through different investments in private companies. So they can be alternatives, real estates, or even private companies. So some of the methods they use can be a buyout strategy, where they buy out the private company in order to actually improve its financials and exit at a higher cost. Through an IPO or through another sale to another company. So unfortunately, the details of the specific companies that they invest in are not disclosed by the private equity funds. However, the vintage years or the years that these companies are being incorporated is around more than 10 years. So these companies are not just your small growth or companies that have just started out, but rather well-established companies within in their space. And I also like to add on to the question on the 5-year swap offer rate. So every week, my team and I post a article called the Bond Market Monitor, where we also post information on the 5-year swap offer rate as well as the 5-year SORA. So you can check out the article every Monday, where we post this information on our websites.
All right. It's a question asking, out of the 3 recommended bond funds, which one should I choose if you can only select one? Well, for this question, I think that it really sort of depends on your risk profile as well. But for me personally, looking at the funds yields or their credit rating and their performance over the past few years and our track record, for me, I think that the Nikko AM Shenton short-term bond fund would be the one that I would choose if I can only invest in one of the funds. Because I think that for this Nikko AM fund, its credit rating is actually one of the safest of these three funds at only about A-, whereas for the rest of the funds, the credit rating is slightly lower at about BBB+. And in terms of the yield, I think 5.1% for the portfolio yield, which is not including the management fee. I think that is pretty decent and actually provides quite a good yield pickup over your fixed deposits or even your T-bills. And besides that, the expense ratio, which includes the management fee, is also one of the lowest out of the three different funds. Its expense ratio is only about 0.4%, which I feel is rather low for a bond fund. So yes, in terms of the funds, if I can only choose one, I would choose the Nikko AM Shenton short-term bond fund. And not to mention that its portfolio is also diversified across many different geographical markets as well. And a new question just came in. Let me just read out this question. Usually, inverted yield curve signals a recession. So what is our point of view on this, and how should investors reposition ourselves before short-term yields start to fall, or if the Fed stop or pauses or cuts the interest rates? So yes, indeed, the inverted yield curve historically does signal a recession, not to mention that this inversion of the yield curve has been at its deepest level since the 1980s. So for us, we do think that a recession will be coming by the end of this year, and reasons being that the global central banks, including the Fed or even the ECB, they are on their most aggressive tightening cycle in many, many decades. And with all of these central banks all on their monetary tightening cycle simultaneously, we think that that is going to slow the economic growth of the major economies around the world. And that in turn, with US as a growth slowing, we see the growth in Europe also slowing. We think that that's going to cause a global recession by the end of this year. And for that, when a recession comes, how do we position for this? For this, we actually prefer fixed income over equities right now in view of the recession environment, as well as because of high inflation. And within fixed income, as I mentioned, we do prefer investment grade bonds because these bonds are relatively safer as compared to high yield bonds. And we think that credit spreads for high yield bonds, which credit spreads mean that it's the risk premium that investors want over US Treasuries, for high yield bonds is going to widen quite significantly as investors demand greater compensation for greater credit risk, risk of downgrades, or even for the default risk. So that is why we prefer investment grade. And besides that, in terms of duration, we still think that investors should stay in the short duration, on the shorter end of the yield curve. Firstly, because the yield curve is inverted. That means that short-term bond yields are much higher as compared to long-term bond yields. So investors are not compensated enough for going long duration because of many risks involved, such as inflation, expectations of inflation going higher than what markets are expecting. So yes, with that, we think that investors should go for short-term bonds as well as investment-grade bonds. And we do think that the Fed is not going to cut rates this year, unlike what markets are expecting. For markets, even after the US inflation data earlier this week, markets, they are still pricing in rate cuts in the second half of this year. And we do not think that this is going to happen. We think that the Fed is more likely to pause rates. And with that, a rate pause instead of a rate cut, we also think that it's not a good time to move towards long duration bonds entirely. If you do want to increase your duration exposure, do it gradually and not going from short right away to long duration, because that's going to increase a lot of interest rate risk. And I also want to take one more question from the Q&A, asking about some of our recommendations on global bond funds. And for this global bonds, we do have a recommended fund, which is called the Allianz Global Opportunistic Bond Fund. And the share class that you should go for will be the SGD hedge share class in order to mitigate any currency risk. And to share a bit more about this fund, what this fund does is that is actually quite different from many of your traditional bond funds in a way that this fund, it has an unconstrained strategy, meaning that it's not benchmarked to any fixed income benchmark, but instead it is benchmarked to a cash-based index. So the fund targets to return a certain amount of returns over a market cycle, and is not constrained to investing in just a certain type of credit asset class, such as corporate bonds or government bonds, or is not constrained in terms of duration as well. So what this fund does is that during a rising interest rate environment, like last year, for instance, it actually shifted its duration to near zero in order to protect the fund against rising interest rates. And as the inflation and the interest rate situation gets better, this fund over the last few months has increased its duration back to about 3 years. And it mainly invests in the investment grade bonds, in particular US Treasuries, because those bonds, they are considered as very safe. And the fund manager also believes that US Treasuries, which are on the shorter end of the yield curve, is providing a lot of value. And overall, this portfolio of the fund is yielding at about slightly over 4%, 4 to 5%. Yeah, and so this is one of the recommended funds that we have, which is the Allianz Global Opportunistic Bond Fund.
All right, thank you, Hui Shi. Thank you, Teng Chong, and also thank you to all our attendees tonight for your attention, as well as your very good questions. I noticed that there are some more questions coming in, but if you don't mind to just stay online, we also have our team of investment specialists who are actually going around and typing the responses to you, especially the questions about looking for certain recommendations for funds. But for now, we will thank Hui Shi and Teng Chong, and we will release them. And I'd just like to share with you also that if you are interested in these webinars, if you find these webinars helpful, do stay tuned to fsm1.com. We've got a lot more of these informational sessions coming your way. So look forward to more market outlooks and more investing ideas. We will bring those to you in the early part of March. So do look out for the information that will be coming soon. With that, that's all we have for tonight. So once again, if you don't mind just staying online, if you have a question that's been posted, we'll get round to responding to you by typing the answer over in the Zoom question and answer. But otherwise, that's all we have for you tonight. Thank you, ladies and gentlemen. Wishing you all the best, good health, stay safe, and take care, everyone.